Bonds have options. Well, yes, you heard it right. Bonds have options to either call or put or convert. And today we'll be talking about these bond options. But before that, hey, I'm Shubham and I welcome you all to this knowledge series by SMEST Discover, where you will get smart about investing. So let's begin. So what is bond option? A bond option is a contract that gives the issuer or the investor the right to buy, sell or convert the bond. These options are not distinct tradable bonds but rather a component of the bond itself. Also, a bond having an option embedded in it like call, put or convertible is referred to as an embedded bond. Now, let's discuss these options one by one. First, let's look at callable bonds. As the name already suggests, the bond with call option is called as callable bond. In this, the issuer has the right to buy the bond back from the investor before maturity on a specified date at par value. For example, suppose a bank issues a 20-year bond with 10% interest and adds a call option into the bond. This will allow the bank to redeem it after a predetermined period of time, such as 10 years. This way, the bank won't have to keep paying 10% to the bondholders if the interest rate drops to 7 to 8% in the next 10 years. Callable bonds often pay higher interest than the non-callable ones. And this is because you, the investor, are taking a risk that the issuer will call back the bond when the interest rates are low. And you will have to reinvest the money at a lower coupon. The second one is the puttable bonds. This bond allows the investor to sell the bond back to the issuer before maturity at a predetermined date at par value. But let's talk about what happens when the investors hold the put option. Say the bond is paying 7%, but the interest rate in the market has gone up to 11%. The bond investor would obviously realize that he's losing out on higher interest. So he will exercise his put option, get the bond redeemed and will invest at the current market value of 11%. Because the put option is favorable to the bondholders, the bond will be sold at a premium compared to the non-puttable options. The put option adds an extra layer of security to the bondholders as it gives them a safe exit strategy. The last one is convertible bonds. This is a type of a hybrid security that offers the investor the right to convert the bond into a predetermined number of shares of the issuer's equity. Convertible bonds are popular amongst both the investors and the issuers as they offer the potential for both income and equity appreciation. Now, let's talk about both the parties' perspective to understand the convertible bonds more. From the investor's perspective, it gives the bondholder the ability to convert the bond into shares in case of equity appreciation. Also, the bondholders get downside protection. That is, if the share price appreciation does not happen, the bondholder continues to get coupon payments and principal repayment till maturity. From the issuer's perspective, they get reduced interest expense because of the convertible options embedded in it, and hence are able to issue bonds at a lower coupon rate. Also, the issuer has the advantage of elimination of debt if the conversion option is exercised. But this dilutes the equity of the existing shareholders. Well, that's all for today and I hope you understood these options embedded in the bonds. Visit smest.in and take the next step towards investing wisely. But before signing off, always remember, investment in debt securities are subject to market risk. Read all the offer documents carefully. For any queries on this video, leave a comment below and see you in the next video.